Okay, I want to go over some of this option stuff again. We'll eventually get into some ways of thinking about the firm as a call option, or at least the stockholders of the firm as owning a call option on the firm. The underlying assets of the firm being like the stock in the call option on a stock example that we've looked at. So we'll get to that eventually. I want to go over one really key result in finance, which is called the put call parity. And so that's we've introduced puts and calls. We reviewed those a little bit last class on Friday, and there's a fundamental and necessary relationship between the prices of those two financial instruments. Of the price of a call has to be fundamentally related to the price of a put. If they're not related in that fundamental way, there would be a way for somebody to buy one at lower cost and sell it at higher cost in order to make a profit. And so there would be arbitrage opportunities in the event that the price of a call and a put are out of line with one another. And so that ensures that there's a systematic relationship between the price of a put option and the price of a call option. And so I'm going to go over that today. That's a really important result in corporate finance. So I think I'll start with that, and then we'll get into the effects of mergers and acquisitions on overall firm valuation using this options framework to value a firm, using this idea that you can think about the firm as the stockholders of the firm as holding a call option on the firm. Okay, so that's where we're headed. Just to review, this is sort of the fundamental payoff structure of a call option. So there's, in this case, we have some expiration date in the future, at which point the owner of this call option is able to buy this stock at $100. $100 in this case is the exercise price. $100 is the exercise. That's the price that the owner of this call option has the right to buy the stock at this $100 price, at the exercise price. And we talked about how when the price of the stock at expiration is higher than the exercise price, when it's say $100, then there's a possible net benefit that the owner of that call option can get by buying the stock at $100, which they've agreed upon in advance, and then selling it at $110 in the market and earning a net payoff of 10. In the event that the price of the underlying stock is less than 100, then they'll walk away. There's no point in buying the stock at 100 when the current market price is something less than 100. Similarly, with a put option, a put option is just simply the right to sell an asset at a fixed price at some point in the future. In this example, if the exercise price, the price that they agree upon that the owner of the put option can sell the price at, if that price is $50, then that put option has positive value when the stock itself has value less than $50. If, say, the value of the stock at the time that the option expires, if the value of that underlying stock is only $30, then the owner of the put option can buy the stock at $30 and then sell it at $50, which they own the right to do that as per they're holding the put option. And so that will give them a net payoff of 20 if they're able to observe that the stock price is actually less than 50. If it's 30, say, then they're able to take advantage of that difference. Okay, so let's think about let's just think about two strategies here, and this is going to be all strategies referring to, say, a single stock. So one strategy is going to involve a combination of two activities. One activity, in one case, you buy you buy the stock, so you own that stock, but you also buy a put option on the stock with some exercise price. I'll call it E. E is the exercise price in that case. That's the price that you're able to sell the stock at in some future time period. So we can think about the payoffs to this strategy. The x-axis, I'm going to draw some graphs here. The x-axis, this is the stock price. And then on the y-axis, this is going to be the value of the stock, which is essentially just the stock price. Those are the same thing. So that's just a one-to-one correspondence. The stock price is equal to what you could get for the stock in the future if you wanted to sell it. That's kind of just a trivial relationship. But there's also going to be, say, an opportunity to buy a put option on that stock as well. You might be able to buy a put option, all right? And the put option is going to have some exercise price E. You're allowed to sell that stock at price E in the future. So this is the again, this is the stock price on the x-axis, and then on the y-axis, this is the value of the put option. There's going to be, just as we saw before, the shape of a put option payoff is it's the inverse of a call option payoff. It's 0 for everything above the exercise price, and then it slants upward, kind of at a slope of -1 for everything below the stock price, right? So that's the structure of the payoff to a put. So this is going to be, payoff to the put option is going to be like that, something like that. Okay, so now if you think about this strategy A, if you buy the stock and you buy the put option with exercise price E, and you think about combining those two positions together, what will your eventual payoff be? Well, your payoff will be essentially the vertical sum of these two individual payoffs. So if we add these together, this is going to have some new payoff. This financial position of owning the stock, but also owning a put option on the stock, we can figure out the payoff to that. And that's going to be overall what strategy A is. Overall, this is strategy A. Now, notice that the portion of these two, between 0 and the exercise price, these two segments here actually exactly cancel each other out. If you add this point to this point, and you add this point to this point, and you do that for all the points between 0 and E, that's actually going to be something that looks like this, just a horizontal line. Those payoffs are going to exactly sort of cancel each other out, and there's going to just be a vertical line, or a horizontal line at that value, sort of at that level E, right? And then the value of the put option for stock prices that are above E is 0. And so if you add 0 to the value of the stock for stock prices above E, that's just going to be that upward sloping line segment. So that entire that payoff for the combination of the stock and the put option, when the stock price is above the exercise price E, that payoff is going to be equal to just something that looks like that upward sloping line. So this is the payoff. This right hand side thing. This is the payoff to. That's the payoff to strategy A. It's equal to the exercise price for values between 0 and E, and then it's an upward sloping line for values of the stock that are above E. Okay, so that's strategy A. Now let's duplicate this. So I have I'm going to make this strategy B. In this case, this strategy is going to involve buying a call option. So this is going to be buying a call option and buying a zero coupon bond. Okay, so up above we have, okay, so we have strategy A, again, which is buy stock and buy the put option. The payoff to that is this thing on the right-hand side. Now let's think about buying the payoff to buying a call option and buying a zero coupon bond. So the value of the call, I mean, this call option is going to have exactly the same exercise price E, and the zero coupon bond is also going to have face value equal to E. That's going to be critical. So this call option has exercise price E, and the zero coupon bond has face value E. Okay, so the value of the stock, if again, if we have these expiration or sorry, these exercise prices, which represent the prices that, in this case, that the person can buy the stock at in the future. The payoff to the call option is going to look something like this. It's going to be zero for exercise, or sorry, it's going to be zero for stock prices that are less than E, and then it's going to increase in a linear fashion with a slope of 1 for stock prices that are above E. That means you can make money on owning the call option. If the stock price is above E, you can buy the stock at E, which you have the right to do. You're entitled to buy the stock at E, and then you can sell it at whatever price it is. So you get that you get to net that payoff if the stock price is above E. And then if you buy a zero coupon bond with the face value E, then your payoff in the future is just going to be equal to E, independent of what the stock price is. So this is just going to be the zero coupon bond has a face value of E. If you hold that zero coupon bond, you are entitled to receive E dollars in the future once that bond matures, and that's independent of the stock price. So that's just going to be a horizontal line, which is independent of the stock price. It's just going to be E regardless of what the stock price is. Okay, so that itself, if we add these two payoffs together, we add the value of the payoffs of the call option, and then this is the value of zero coupon bond, the face value. So that's the future value of the zero coupon bond. Then altogether, this will tell us what the payoffs to strategy B are. And again, we sum these two individual payoffs. We sum these vertically, and we're left with something that has a payoff of E for stock prices that are between 0 and E. I'll just explicitly say this is the stock price. The x-axis here is denoting stock price. So this is the payoff under a particular stock price. The payoff is E for stock prices less than E, because you get the zero coupon bond worth E. And then the stock price, or then the payoff to holding this financial position of a combination of a call option and a zero coupon bond, the payoff to that, in the event that the stock price is above E, is that leg of the payoff for stock prices above E is just a line with a slope of 1, because you get this. You get this payoff from the zero coupon bond, and you also get this payoff from owning the call option on the stock. Okay, so these two strategies these two strategies, the key point here is that these two strategies have exactly the same payoff. The structure of the payoff to strategy B here is exactly the same shape as strategy A. This is just stock price. So for any stock price, any future stock price, the payoff to these two strategies has exactly the same shape. Strategy A's payoff is here. Strategy B's payoff is right there. Okay, so if these two strategies have the same payoff, then they have to have the same costs. If one of those two strategies is cheaper than the other, then you can buy the instruments that comprise whichever strategy is cheaper, and then you could sell that at a premium, repackage it as strategy B at a premium, and actually make a little bit of money on that. And if those two strategies cost different amounts, then all investors are going to flock to the strategy that costs less. That's going to have an effect on prices. That's going to equilibrate the prices until those are equivalent, until those strategies have equivalent costs. So the cost of strategy A, which is remember strategy A is buying the stock, and then buying a put option. So the cost of strategy A is going to be the price of the stock plus the price of a put option with exercise price E and expiration date and date T. That's the cost of strategy A. It's going to be the prices of these two financial instruments. Okay. Now let me duplicate this. We have strategy A. Now let's consider strategy B. It's going to be the price of a call option on the stock with exercise price E again and expiration date T. Strategy B was the call option and then a zero coupon bond. So then this is going to be the plus the price of a zero coupon bond with face value E, maturity date T. So we can actually re-express this as this is the price of the zero coupon bond with face value E and maturity date T is actually equivalent to the present value of the exercise price. So those are equivalent. This price of the zero coupon bond with face value E and maturity date T, that's equivalent to the present value of the exercise price. Because your zero coupon bond pays you E dollars at some future time period T. So in present value terms, that's E discounted back to the present. That's what the price of this zero coupon bond would be from the perspective of time zero when you're evaluating these two payoffs. All right. So again, we have the cost of strategy A, which is the price of the stock. You have to buy the stock. You have to buy the put option. Those are the two components of strategy A. Is the stock and the put option. That's the price of the stock plus the price of the put option. Strategy B, again, is the call option and the zero coupon bond. So the cost of that strategy is the price of the call option plus the price of the zero coupon bond. Again, so if those strategies have the same payoffs, then they have to have the same costs. Otherwise, you'll have investors only choosing one of those things and none of the others, and then prices of those assets will change as the demand plummets for one and increases to the sky for the other as investors reallocate their portfolio between these two different types of financial instruments. So overall, these two, the fact that we know that these strategies which have the same payoffs also then must have the same costs by the arbitrage idea. That leads us to this this important result called the put call parity, which says that the price of the stock plus price of the put is equal to the price of the call plus the PV of the exercise price. Okay, so that's what this put call parity says, and the way that we arrive at this is again just considering the payoffs to these two strategies, noticing that the payoffs to the purchase of a stock and the purchase of a put has the same payoff as the purchase of a call and the purchase of a zero coupon bond with the face value equal to the exercise price. So those have the same payoffs, and therefore they must also have the same costs in order for there to be no arbitrage opportunities left over. Okay, so that's the put call parity. Now let's just do a little example, just to cover this. So I kicked off this lecture mentioning that if you know the price of a call, there's a fundamental relationship between the price of the call and the price of the put. There has to be given the payoffs to the two, and given the fact that the payoffs are, if they're the same, then their costs have to be the same. So if we observe, say, this is just an example, if we observe an $80 stock price, so this is going to be just an example of a call and a put option on a particular stock. So the stock price is $6, and if we observe that there's a it's costing right now the price of a call option, or the price of a 3-month call option. The price of a 3-month call option, that is, it's the price of the right to buy this stock, the right to buy this stock at $85 anytime between now and 3 months from now. That right is going to cost you something. To have that right, to be able to either exercise it or walk away, that right is going to cost you $6. That's the price of that call option. And then if we know the risk-free rate of return, let's say there's a 0.5% monthly. Let's say that's the monthly risk-free rate. Okay. So then the question is, what is the price of a 3-month put? A 3-month put option with exercise price also $85. So the critical thing here is that the put option has to be in exactly the same time frame as the call option. So it has to be a 3-month time frame, and the exercise price has to be the same. So it has to be, this put call parity only works when the put and the call option are in the same terms. They have the same exercise price and they have the same time until expiration. Okay. So what is the price of a 3-month put option with exercise price $85? We can actually derive what that would be, given that we know these parameters. We know that the stock price is currently $80. We know that it's currently $6 for a 3-month call option, and we know the monthly risk-free rate is 0.5% monthly. Okay, so we're essentially going to use this put call parity. We know this. We know the price of the call. We know the price of the stock. We know the PV of the exercise price because we know the exercise price and we know the risk-free rate. And so what we're looking for is this right here. That's the price of the put. So essentially, if we take the stock price, right, and we move this, we subtract the stock price from each side of this equation, we move this to the other side, that'll give us the price of the put. So let's take the price of the call, which is $6. We need to add the PV of the exercise price. So the exercise price is $85. And the PV of that, it's 0.5% compounded monthly. So the PV of that $85 then would be $85. That's $85 3 months from now, which at a 0.5% monthly rate, that's going to be 0.005 to the third. So critically here, the rate is in months, and then the exponent is also in months. So as long as those are in the same terms, then we're okay. That rate's in months, the exponent's in months. Now we have to subtract off the, what do? We subtract off the price of the stock. That's $80. So subtract $80 for the stock price, right? And so if we this $85 over 1.005 to the third, that's equal to 83.74 minus 80 plus 6. So the price of that put then has to be $9.74. Okay, so that's how you would solve a problem like that. If you're given some of these parameters, like the stock price or the call option price or the risk-free rate of return or the discount rate, you can figure out the price. If you're given any three, you can figure out the price of the remaining one based on that put call parity. Okay, so we talked about how firms are the stockholders of a firm are essentially owning call options, but we can actually if we can frame them as owning a call option, this by the logic of this put call parity, there's also a way to rearrange the firm, rearrange the ideas to express them in terms of a put option. That's explained a little bit in the book in chapter 22 of how to think of the firm as a put option. It's a little bit less intuitive at first glance than thinking about the firm as a call option, but based on this put call parity, we know in theory that the price of the call and the price of the put are fundamentally structurally related to one another. And so if you can express the firm value or express the payoffs to stockholders as being a call option, then you can come up with some equivalent formulation that would be expressing the payoff to stockholders in the form of a put option as well. That's what we can deduce from this put call parity. Okay. All right, so that's the put call parity. Let me just review this idea of firms as options. We talked about last time how there's this situation where bankruptcy allows the firm to minimize its downside in the event that it falls on hard times, in the event that the economy hits a downturn, their cash flows decline. They're not able to meet their debt obligations. They'll meet with the lawyers of the bondholders, and perhaps they'll restructure a little bit, but it's possible that the bondholders will not get all their money that's owed to them, provided that the owners of the firm and the managers of the firm haven't been engaged in any sort of foul play or dishonesty in the dealings of the firm. As long as they've made a good faith effort and been transparent with everything they've done, then bankruptcy law allows them to absolve themselves of their complete debt obligations. They have to, whatever cash they have to pay out to the bondholders, but they don't have to. They're not obligated to make up the difference in the event that their cash is not enough to supply what the bondholders are owed. So that's equivalent. We saw before how this is equivalent to a call option for the stockholders. If the cash flow of the firm is larger than, say, 800, if the interest payments are 800 and the cash flow exceeds 800, then the equity holders get the cash flow minus 800. In the event that the cash flow drops below 800, the equity holders are left with zero. And so that has the same structure of payoffs as a call option, where critically, this 800 is like the exercise price of the call option, but in the case of the firm, it's like the debt obligations of the firm. So the debt obligations are equivalent to the exercise price in this call option analogy. Okay, so we have the call option. The value of the call option is 0 for cash flows between 0 and 800, and then it's cash flow minus 800 for the whenever cash flows are larger than 800. So equity holders, returns to equity holders, they take home the difference between cash flow and 800 in the event that cash flows exceed $800. Okay, so that's the sense in which the equity holders, the stockholders, it's as if they hold a call option on the firm. Okay, bondholders in that event, if the stockholders own the call option, then it's like the bondholders have essentially sold a call option to the stockholders with an exercise price of 800. Okay, so this option has sold from the stockholders to the bondholders. Sorry, it's been sold by the bondholders to the stockholders. The payoff, the shape of the payoffs to that, someone who's selling a call option, someone who's sold the call option, their payoffs are going to be something more like the bondholders get essentially, $800 in the event that cash flows are larger than the $800 debt obligations. But then in the event that cash flows drop below that, then it's possible that the bondholders will not get their full amount. So that's what the payoffs to bondholders would look like. Right, so the bondholders just get the value of the cash flow in the event of the cash flow being less than 800, and they just get 800 in the event that the firm is able to meet its debt obligation. I have one more point I guess I just want to make here. This is the idea of the intrinsic value of the option. That's whatever the option is worth at the expiration date. So once the expiration date occurs, you know whether or not the price of the stock is above or below the exercise price. You know that the cash flows are either above or below the debt obligations, and so the intrinsic value of an in the money call option, we say the option is in the money if the cash flows are above the debt obligations. That's an in the money call option, and so the intrinsic value then is equal to the cash flow minus the 800. But the intrinsic value then is just 0 once the cash flows have come in, and we know one way or the other whether or not the cash flows are greater than 800 or less. So that's just a term the intrinsic value is what the value of the option is at expiration date. Okay. In thinking about this merger stuff, this is actually, we're going to draw concepts from what we had talked about last time, thinking about the payoffs to stockholders under projects that have different risks. And so the inherent riskiness of the cash flows is actually going to be a key parameter for determining whether a merger is going to be a net positive or a net negative for stockholders. In the absence of synergy, so there could be a way that a merger is synergistic, where the two companies together can in some sense generate higher cash flows than they could separately, than the sum of their cash flows if they were separate units. Maybe there's some organizational advantages to having them be vertically integrated or all part of the same firm. Maybe they can save on certain kinds of administrative costs, or they can save on certain kinds of transactions costs by being one firm rather than two. So there could be synergies that allow mergers to actually create more value. There's also a thing where firms that are kind of low on liquidity will want themselves to be bought out by a larger firm in order to kind of help their cash flows. And so they might, if they know that their financial statements are in a little bit of trouble, and they're not, they're short on cash, they might try to pitch themselves as a potential buyout option from a larger firm. They might try to make the case that it would be to the advantage of a larger firm to acquire them, to buy them, to acquire their assets, and then therefore kind of infuse them with some cash. That's another reason for acquiring. But there's also a reason for merging, which is based on the diversification effect or the diversification principle. So if we think about two firms acting independently, maybe their cash flows are somewhat correlated. They're both related in some way to the performance of the market as a whole or the performance of the economy as a whole. But their cash flows, if you combine them together in a portfolio, just like if we combined two risky assets in a portfolio together, it's possible for the combined variance of those cash flows to actually be less than the sum of the individual variances. And there could be actually some sense in which the overall cash flows are made less risky as a result of a merger, which helps diversify the cash flows. So what this would do is, if one firm's cash flows are up, or maybe you think about it this way: if one firm's cash flows are down, the other firm's cash flows could be up a little bit, if provided they're not perfectly correlated. Then their combined cash flows could be something closer to zero or maybe even positive when you combine them together. Whereas the firm that's just having negative cash flows would be in more trouble if they weren't diversified, if they weren't part of one larger firm, if they weren't all under one umbrella. Their cash flows could be a little bit less volatile. So there can actually be a overall reduction in variability for the firm's cash flows when two firms merge. Okay. And this is going to be, we'll actually show, let's go back. Last thing I'll do today before we analyze this formally next class is I'm just going to go back to what we had talked about before, where, the riskiness, the inherent riskiness of the firm is going to be paying off differently to stockholders and bondholders. So the inherent riskiness of the firm, we saw last time that the riskiness to stockholders, they get 0 in a recession, they get 100 in a boom for the low risk project. They get 0 in a recession, but they get 140 in a boom for the high risk project. And even though the NPV of the low risk project is higher, the stockholders get an expected return of 50 for the low risk project and an expected return of 70 for the high risk project. Okay, and so this gets fundamentally to the point about the relationship between mergers and then the value of equity. If you think about the equity as a call option, then the value of that equity actually gets larger as the firm's cash flows get more variable, as the firm's cash flows get more volatile. And so a merger that's going to reduce the volatility of cash flows is going to have the opposite effect and actually reduce the expected value of returns to stockholders. And so that'll be the punchline of next the beginning of next class when we finish up this application of options to mergers and acquisitions. But we've sort of developed all the kind of concepts we need for this last time, and then today with the put call parity. And so on Wednesday we'll put all this together and think about how to evaluate a firm under a merger, how to figure out what the value to the shareholders are, the value of the equity is, how the value of the equity changes after a merger occurs, which reduces the volatility of those cash flows.